Hey Trader, Steven here with thetradersplan.com. It's Thursday, February the 21st. I got a couple hours before the market closes, so we're going to do something a little bit different today. We're going to spend a little bit of time on the market. There's not really a whole lot that has changed from last week. You can see we're up a little bit more, but we're kind of in this zone right here of potential resistance, even though so far the market seems to be able to take it out the resistance. But we're going to do something different today. We're going to look at every single trade that I have taken and closed this year. So I'm going to analyze that right in front of you, and I'm going to do that because I'm still always looking to update my trade plan and get better, and I'm hoping by you seeing every trade that I take, my results, that it also inspires you to, take some of my ideas and either make them your own or update your own strategy, right? So we all continue every month need to make sure that our trade plan continues to work and continues to make sense for us. So we're going to look at that. Another thing I'm going to do is I'm going to show you a strategy to swing trade around some of your longer term positions. And, if you have a stock that, what I call the Warren Buffett stock, you really want to hold forever, but you still like to swing trade a little bit, I'm trying to open your thoughts and your ideas to the possibilities that how to grow your individual stock or your long-term hold much, much greater by swing trading around that position and reinvesting the gains just back in the stock that you want to hold long-term. So we're going to look at some real live examples. I'm going to show you some numbers on how that could potentially work in a conservative scenario. But again, that's a long-term strategy. So let's really start right here with the NASDAQ. Again, I'm not going to spend too much time right here. We're up a few points. The NASDAQ, is just kind of eating its way through the 200-day moving average. So right now, absolutely everything still looks bullish. The breath has not rolled over. I'm starting to be open to the idea that we could, come out of this, but obviously as the market is still gone straight up. So maybe a pullback would be reasonable, and sometimes waiting on pullbacks, you do have to be patient. But that doesn't mean you always have to go out there and just sell everything, right? You want to hold your stocks as long as you can, as long as they're working. I tend to, most of the time, I sell my stocks a little late, because I'm kind of a trend follower in nature, so I want to hold them as long as I can until I'm starting to see that I could give back. I don't mind giving back some, but significant gains. So, hold some stock, but once you start to see trouble, which I have really not yet, then you can, take precaution action. But you can see the NASDAQ continues to find support multiple times on this 20-day moving average, which is the rally line. I think the 50-day moving average is kind of that come to Jesus line right in here, right around this 7,000 level where it kind of found support a couple times. You can see the long candles went under it, closed above it. So, that I would like to see if the market pulls back more than just a little 2-day pullback. Excuse me, I have allergies. I'd like to see that line hold. I think that would be a pretty important support line, especially, I don't think this is an inverse head and shoulders, but one could already. You got a shoulder over here, the head, and it still needs to produce this shoulder. But I think going straight up, it could go up for another couple days, another couple weeks, but I think that's probably unrealistic to expect it to just shoot straight out of here. But hey, you never know. That's why you want to hold on to your stocks. But right now, we're in this zone right here. Could get just that exhaustion gap like you did right here, and then kind of time for some pullback. But right now, the VIX is going lower. The S&P 500 still looks pretty good, as it is definitely above its long-term moving average. As you can see right here. So it's just been a nice rally, a nice steady rally. And to be honest with you, this has gone further than I thought it would. But, I come back and just going through what I know and all the rallies, they always seem to just extend a little bit further than anticipated. It has tested the line twice. Sometimes I've noticed third time is not always the charm. And same thing when something's trying to bust through resistance. When it's finding support, sometimes third time, if it gets busted, you can see rejection here, came all the way back, busted through the third time, support here, could break on the third time. And for the reason that happens is there's not a magic number 3. Could be 4, could be 2, but just sometimes you got to look at the market. Could get tired and it just needs a breather. It needs time to digest. We don't know what it's going to look like, but right now the market maintains its bullish stance. Now, we can go right here and kind of see the NASDAQ started really weak, came all the way back, and we're going to see what it does here. And these are definitely the times in the rallies where sometimes I like to look at non-correlated assets. Like if I feel like I have to place a trade or just, I see something, I start to try to open my mind to maybe non-correlated assets late in the rally. And what I consider late in the rally is it's already really made 2 major tests of the rally line and is breaking to new highs. So at that point in time, if I see other things that might be not correlated, like certain commodities, I'm more open to investing in those if I see the right setups, just because, I don't like buying major growth stocks after that second test. It's just historically kind of proven not the best strategy unless you're looking for 5% gains, which I'm not. I'd rather just hold out because I'm looking for 3 to 1. So if we do look at the table view, you can see right here the spider, the technology is doing pretty well. The technology, utilities, and staples. It's really weird sometimes to see technology and utilities up there, but that's happening. Okay, so but 2 out of the 3 that are leading today are more defensive in nature. One day means absolutely nothing. One day is not going to break a trend or not going to break a rally, but just kind of something worth watching. But technology is still up there, so I would consider that to be bullish. Let's kind of go look at I want to look at the sector summary on the perf chart side of things, just so we can see, okay, what has done in the last 5 days. So you can see materials and energy have done really well. Staples and real estate have lagged, and that makes sense. The market continues to go up. Staples are in the top 3 today. But materials and energy commodities have lagged. Now, you had OPEC that came out last week, and that caused energy to surge because they had production cuts and materials. You've had gold and other miners really spike this week. So that is, I kind of expected that to be up there. So, again, 5 days in anything, but most of the time, a lot of these haven't really made a lot of headway. Financials are starting to make a little bit of money here. Let's see. Oh, sorry, that was compared to the S&P 500, so excuse me. But if you look at that, if we do go back to this chart, you can see the materials or energy have significantly outperformed the S&P 500 in the last 5 days. Sorry, I didn't realize that was, but you can see most of them, staples is still the laggard, real estate is still the laggard, which is a positive. So we'll just kind of keep it in mind. But again, if we kind of go back to the market, it just hasn't really done much. It's just still kind of grinding its way higher. So we'll just kind of keep our eye on everything and see what happens. Because I think yesterday in the last couple minutes of the market, there was last 20 minutes of the market, there was a sell-off. So there's definitely some anticipation of a pullback, but it just hasn't happened yet, and the market climbs a wall of worry. So I want to really move on, and like I said, I'm going to do something different today. So I want to talk about some of the changes I made at the beginning of the year, and we're going to look at some of the trades I've made to really see how I've implemented those, and we're going to look and see if I've made any mistakes and what potential slight minor adjustments I could make to my trade plan. Now, just because you have a loss in your trade does not mean that you made a mistake. A mistake, as Dr. Van Tharp identifies, is not following your rules. So I'll have a couple losses in here, and I'll look at it and say, you know what? I wouldn't have done anything different. It just didn't work out. So I think it's important to keep that in mind, that just because you have a loss doesn't mean you made a mistake. What defines a mistake is when you have a predefined trade plan going into a trade and then you deviate from that plan. So what I did to update my 2019 trade plan is I changed my risk model up a little bit. I moved my risk model from 2% per trade to 1% per trade. Now, that doesn't mean I own 100 stocks out of a $100,000 account. What that means is, I'm only risking 1% of my equity on each trade. So for example, if I have a $20,000 trade account, my max loss is 200 per trade, 1%, okay? I can still put as much into it as I want as long as I'm only risking $200 per trade. So to kind of a way to show you how to calculate that is if stock XYZ is at $20 and I think it shouldn't go down to 19, so I put my stop at 19. Well, that's $1 of risk in that stock, and my max loss is 1% of my account, which is 200 bucks, divided by $1 is 200 shares. So what that means is if I'm buying the stock at 20 with a stop at 19, 200 shares is my 1% per risk per trade. And what I changed is I'm only going to focus on investments with a potential for 3-to-1 risk reward. Now, when I say potential, I want to really dive into that for a second. That doesn't mean I'm going to hold it until it hits 3-to-1, right? What that means is I'm looking for fast-moving stocks that have the potential to hit that 3-to-1. So if I risk 5%, I'm looking for a 15% movement. I just identified. So if I risk 10%, I'm looking for a 30% gain. But obviously, once you get into the trade, if something starts to break down, you take your profits wherever, whenever you decide that the trade is starting to fail. So I'm looking for faster moving stocks, and I need to because now I'm risking less per trade. So the advantages of lowering your risk per trade are, for me, I'm forcing myself to take trades that I previously was scared of. It allows me to take trades that I was previously scared of. So faster moving stocks that might need a 10% stop loss, normally I would pass on those because I like 5 to 7%. Well, now that I have a predefined risk per trade, I can take those trades because I'm also not focusing on a 10% stop loss. I'm focusing on one risk, 1% per trade. So, but because now I'm focusing on 3-to-1, I have to take those faster moving stocks, right? Because I need that 3-to-1 to make up for some things. So by risking, another advantage by lowering the risk per trade is I'm becoming less emotionally attached per trade. And, you know, that just means that I don't have as much invested in a stock, so I can give it more daily room to breathe. And most stocks do need room to breathe. So because I'm less emotionally attached, I'm more likely to stick to the trade plan that I put in place. Now, due to less emotional attachment, I'm also letting winners run. There's a downside to that, and we'll talk about it here in a minute. But because I'm not emotionally attached, I'm not focused on taking immediate profits at 5%. Because, again, you're not going to get very far if you're taking quick profits on every single thing. So I'm allowing, and I have the mindset to let the winners run because I don't have as much at stake. Now, another advantage of lowering your risk per trade is I can lose 10 trades in a row, and my whole account's only going to be down 10%. I'm going to repeat, if I'm only risking 1% per trade, I can lose 10 in a row. I'm only going to be down 10%, right? I can live through that. It also forces me to think about risk reward. So before I look at a stock, I'm going to say, okay, let's look at this for a second. Does this have the potential of a 3-to-1 risk reward? Some of the slower moving stocks, the answer is no, so I'll just pass on them even though it's a good setup because I'm looking for something that can move very, very quickly, potentially. Because typically what happens is I find if you do buy a slower moving stock, I'm actually losing more often because a lot of times the time you need to let that slower moving stock move to make a gain, that rally is over and then it starts to pull back again. So slower moving stocks need a lot longer time frame. So with faster moving stocks with 3-to-1 reward, I can choose a much shorter time frame. And I forces me to let winners run right here. Okay, so again, because I'm only risking 1 per trade and thinking about the 3-to-1 reward, it's forcing me to let winners run. Kind of doubled up. Disadvantages to lowering the risk per trade. I have to take more trades, and that's going to, because I'm typically putting about 12 to 15% per trade of my account value versus 25% previously. I was putting about, you get a 20,000 count, put about 5,000 per trade, boom. Well, I've lowered that risk model, so I have to take more trades because now I'm taking the trades that I previously wouldn't have, and there's more transaction costs to that. Small winners are not going to make a big dent. So going back to the 3-to-1 risk reward, this is a disadvantage. So it does not make sense with this model for me to try to take profits at 5% every time, right? It's not going to say that I'm not going to. It's just because you have a smaller percent of your account in it, it's going to make a smaller dent in your portfolio. Some markets are not going to produce big winners, and that is just a fact. You know, if I'm waiting for a double, it might not happen in a bear market. So you have to make sure that you adjust I'm going to adjust my trade plan accordingly to maybe instead of 3-to-1, I try to shoot for something that might be 2-to-1 in a bear market. Could watch gains erode. So that's the downside, and I have a stock that literally happened because I'm letting my winners run and not taking immediate profits like I might have. Sometimes you're going to have a winner like 20%, like one I'm going to show you here in a minute, come down and become a loser, or come down and be a break even. Now I'm going to tell you something. And that sucks. Trust me, it sucks, but you have to get over that. I looked at every single trade I made in 2018, and my two biggest winners made the bulk of my account value gain for the year. All the small losers and all the small winners paid for themselves, but the big winners are what helped me outperform the market last year. So I'm looking for big winners. So I can look at last year's and say, without those big winners, it would have been a lot more tougher. I probably would have performed more in line with the market than outperformed. So it's just kind of something to keep in mind, and something you're going to have to mentally prepare yourself. So this right here is almost every trade I've made. I do have some that are not highlighted here because we're still in them, and I don't want you necessarily just to go out and buy them, and my subscribers are privileged to that information. So these are mostly my closed trades. So we're going to look at these one by one. So I had a nice string of wins, a couple losses, string of wins. This one I do still own. We're going to talk about this here in a second. That's why it's white. Drip and USAS, which we just booked some profits on it yesterday. So done pretty good. You know, I'd say one out of all these trades. How many do I have? 17. I have 12 winners. Okay, so not bad. 12 out of 17. So, but there's always room for improvement unless I'm batting 1,000, or, you know, unless I'm just have really good risk reward ratio. I'm always looking to improve. So let's look at now that you've seen these trades, let's really look at them one by one. So I'm going to move this off, and I'm going to move the chart analysis back over, and we're going to look at these trades but one by one, and I'm going to show what I could have done differently if I stuck to my trade plan, and let's just kind of go from there. Okay, so right now I have the Innovator 50 IBD 50 mutual fund. This is something that I did only make 5% on. Clearly I could have made a lot more. This was the first trade that I took, and the reason I didn't abandon my trade plan, the reason I didn't let this run is because after you're coming out of a bear market, you're coming after a couple of losses, I was looking for kind of that first confidence builder trade, right? Just get a quick gain. It's okay if it goes on further, but I need to get back in the game a little bit after just a nasty, nasty sell-off. So, you know, I bought somewhere, I can't remember exactly, I might have bought around here. I took profits around here. So I took profits very, very quickly, but it got my mojo back. So I did not deviate from the plan. That was the plan all along. Sure, it continued to run. I'm not mad about it because that stuff is going to happen all the time, okay? So that was part of my trade plan, and I stuck to it. Now let's look at JD. JD, I believe I bought right here on this day. I saw this big volume spike. Let me analyze this for a second just to show you what I was thinking. So a lot of times you've heard me talk about, you know, when you have these big downtrends in stocks or anything, and then it's trying to bump against resistance, which is the 50-day moving average, and it just keeps failing. What I noticed about this stock is that it went from this to it really started curling around. And what I noticed, so momentum is definitely slowed to the downside. And what I noticed is that when momentum slows to the downside significantly, and then it starts to what I could just hugging that 50-day moving average just under it, and then I see some volume spikes coming in, that's showing me that it's likely going to break through. Okay? And it did. I was right. It broke through, and I owned it somewhere around here. So let's look at what happened. So it popped, okay? It popped up here, and it really didn't go anywhere. It came back close to my purchase level, right? And my game plan was this, to really just kind of wait and see what it does with the 50-day moving average. So let me kind of clear this chart a little bit because I muddied it up. I do believe I sold this a little early, but I can call this a mistake, right? Because it did break a little bit below the 50-day SMA right here. So the next day it was looking very vulnerable to the downside. Now, a lot of times when all of a sudden I am unsure of a trade, I just get out. And here's the reason why I just got out for a small 1.5% gain. Because I noticed that Weibo was a very similar stock, and it popped its head above and then rolled back into, you can see a very similar pattern. It went down, started hugging the 50-day moving average, went up, and then failed and went back into the base. So when I saw that evidence, and I saw a couple days where it closed in the bottom of the range, and then I saw Weibo, which is very similar stock, I assumed that it was going to fall back into the base too. So did I make a mistake? You know, my original game plan was to sell it when it broke the 50-day moving average. And it did close. It closed literally right on it. But sometimes you have to also know when to abandon. And there have been times where I abandoned a trade because I wasn't sure. It didn't do what I thought it was going to do, because I thought it was just going to come out and just kind of go up, and then it had a couple days of struggle here. So I think it's okay sometimes when all of a sudden things change and I abandon it. So still got out with a small gain, obviously. It's hindsight. It did go up higher, and I think the day I got out, then some Chinese trade news came out, and then it went up for a little bit. So I look back at this, and I know that even though that my original plan was just to kind of hold it and see, sometimes when I'm in the heat of the battle and all of a sudden just something is unsure, I do need to abandon ship, and that's why I did that. I'm going to, now PAGS, I sold this for a 13% gain right here. I'm going to come back to this here in a second. Let's look at SIL. Okay. So right here, I bought this right here because I got to go back to what I was previously noticing. It was really slowing to the downside, and as the market was selling off, the relative strength line was rising. And then I'm seeing some volume really stepping in. So I did stick to my trade plan here. So what happened is when it broke through right here, it came back. This is when I bought, and I just held on to it. I had a stop under this right here, and I just held on to it. And I come back and I let it test support, and it did, and then it came through, and I sold it right in here for about an 8% gain. Of course, it popped, right? But my game plan right here, the game plan really here was I never really make a ton of money in swing trading ETFs outside of my QQQ trading system. So I said that if I get in kind of that 7 to 8% range, when it looks like it's starting to pull back, I'm going to take profits in the ETF, and I'm going to replace it, if miners are acting right, with some individual faster moving stocks. And that's exactly what I did. Now this did go up, but so did my individual stock miners. So I would say this was a success, 7.8% gain. Did just fine. Let's look at Camping World. Okay, so this is a long-term holding of mine that hasn't worked out too well, but I've been swing trading it to and reinvesting some of the shares, so I will explain that here in a minute. But you know, after the market sold off right here, it just really seemed oversold, so I bought on this day, and with the objective that if the market does, if Camping World goes above the 20-day moving average, then closes below, I'm getting out. So I got in on this day, ended up selling on this day because it moved above the green line, and I got out this first time for just under 7%. Okay, 7% swing move right here. Yes, it sucks that it popped up and then came right back down, but you know, I stuck to the trade plan. Then I did it again. So I was looking at right here, and excuse me. So I bought it right here, and then I also bought it right in here. So I initiated two separate positions, one right here and one right here, because it was looking like the momentum has slowed to the downside, and then I got out both of them in the same day, and that's just, again, that's just how it worked out. I reinvested my shares back in the company. I'll talk about that strategy here in a minute and put some math to it, but I really had back-to-back 7% winners, and I treat each one as a separate trade because I have different stop losses in that on those shares that I bought. So did pretty well on that. And trust me, we're going to look at some ones that I didn't do all so well. Okay, so love, this is kind of a frustrating example. Let me just kind of look at this. Is kind of a frustrating example where my subscribers definitely made more money than me. So it really surged off the bottom, came back, and tested this 20-day moving average. We bought right here on the low. Perfect day, January 4th. It went up. We sold half into strength at break even, half into strength around 10 or 11%, and then raised our stop to break even. Now, when the trade plan was sell half, raise stop to break even, and that triggered on this day. Now, for me, I didn't sell half because I have my 1% reward model, 1% risk reward model, 1% risk model. So it came back and stopped me out for a tiny gain because I moved it up just a little bit, enough to pay for my transaction costs and then some. And then it just absolutely took off. So, you know, sometimes when the market goes sideways, the moving average system doesn't always work perfectly, but it is a simple strategy. And now you can see love, of course, it's the love that got away. So the subscribers, my subscribers, they made about 6 to 7%. I made about 0.5% because I decided to hold on to it, and it just came back and stopped me out. But it kind of goes back to my risk model. Because I'm only risking 1% of assets per trade, max to the downside, I have to give them room to run, and it just didn't. It just continued to go and go and go. So kind of looking at, we have gone through all the winners right here. Now we're going to go through a couple of the losers. So let's move that out of the way. Now I want to look at HEYE, which is, I think that's how you say it. It's kind of a frustrating stock, but you know, this is just one of those stocks I normally wouldn't have bought because I needed a 10% stop loss on it, but I only risked 1%. So owned a little bit of shares, not much, but I bought it on this day as it was breaking through that 50-day moving average, because you can see all the times it hit that resistance, but then it never came and undercut this low. It just curled right back up, and when I saw that breakthrough, that's a change in personality. So I bought, and I held on to it. You know, and this was one that I thought had huge potential. Now, why do I think this had huge potential? Because this over here, look at what it's previously done. Look at how far it's fallen. It's proving that it's a fast-moving stock. So if I bought right and sat tight, you know, I can make some money on it. Well, I got stopped out right here. So it went up. I was up, I think, almost 20%, all the way up here. And I rose my stop to just under break even. So I was raising my stop. Well, there's a couple ways, and I got hit, and that's very unfortunate because, of course, that was the bottom of the day. Now, there's a lot of different ways I could have played this. I could have said, well, you should have taken profits at 10% and rose your stop to break even. Well, if that would have happened, I probably would have got stopped out right here. I was sold half for 10%, half for 0. I probably would have got stopped out right here and only made 5%. So I would have missed this move anyways. Now, I could have also said, well, since my initial stop was under this bar, I could have let it come all the way back down under here. But I'm going to tell you something, why I don't like that idea either, is because if you have a 20% gainer, and then you're willing to let it come all the way back and turn that into a 10% loser, it's really going to mess with your psychology a little bit. Like, that just doesn't work with me mentally. So I just said, okay, I'm going to try to give it as close to my break even as possible, even though it came back. And it did test that 50-day moving average successfully, just enough to stop me out. I'm talking like it came, that day it came and just wiped out my stop and came back. And then it just moved big yesterday and is now kind of down and above average volume today. So, the jury's still out on this. I might buy this stock back. But this was a stock that was really, really hard to play because I bought it up here. It moved up 20% and ended up stopping me out at a little bit more than a 1% loss. So that's kind of frustrating, but I'm not overly frustrated about it because I'm going back to what I know. I know that this is really just 1.5 months of trades. These are 18 trades. I'll probably take 100 trades this year. And I know that my 2 biggest winners last year paid for my year. So I have to be willing to give the stocks room to breathe. And if they go up and come back and stop me out at break even or even a tiny loss, so be it. I don't really want to let it, a nice gain turn into a 10% loser. That's just not part of my personality. This is just one that it sucked that it happened, but it happened and it's time to kind of move on. Now, you can always have a rule to buy it back, right? Yesterday might have been that day. When it's obviously had a big volume spike, I could have bought it back. But, I'm not so sure about the market right now based on how deep in the rally. So I am comfortable doing nothing right now and just kind of finding another entry or finding another stock. But sometimes you just have to be willing to buy a stock back. So this was a big winner that actually turned into just a tiny loser, almost a break even. But again, I'm looking for some big winners. I'm looking for some doubles this year. I believe this one has the potential. It just didn't work out for me on this trade. There's nothing I would have done differently. And that's sometimes when you have to analyze a trade and say, okay, I had a gain, I could have taken half at 10%. Would you really have done anything different? And the answer is no. Because there are going to be plenty of stocks this year that you don't know which ones are going to take off and never come back. And if I'm cutting myself at the knees by just booking profits at everything at 10%, then I'm really cutting myself off from having those big gainers, as I'm confident I will this year. And that's going to just help me outperform and pay for everything. So again, that trend following mentality is you got to cut your profit or cut your losses short. Risk 1% per trade, let your winners run. This one just came back to me. It's a great case study. Okay, so let me kind of shrink this a little bit. So you can see right here that this one, let me look at the weekly chart first. This one had a big volume spike, created a bullish cup with handle, MTLS. And I got it on this day. Okay, it went from 13 to 21 in like 7-8 trading days, pulled back. I said I've seen this before because I have. Look at this surge right here, and then look at the pullback in light volume, then look at the surge again. I didn't think by any means this was over, but I was wrong. I bought right here. It went up about 7-8%. And then it had a really bad wild day. And I had to stop. I said, okay, I'm going to buy right here. If this trade is going to work, it shouldn't go under this flag's low. Okay? It shouldn't. Like, the trade's over. And the trade was over. Woke up one day. Stock was down big. It stopped me out right here. I didn't get stopped out like way down here, stopped me out, and then it continued to move down, and then you can see where the stock is at. So this was just, I look back at this, I wouldn't have done anything differently. It's an aggressive stock with my 3-to-1 target. I only lost 1% of my account value. Okay? So, didn't work out. Okay. In IU, this is a trade that I had a 1% gain on. I had it planned. When it started to break out of this, I was going to buy it. Oh, excuse me. And that's exactly what happened. So it surged right here. I bought it right here. And then it started to go up. And then it just really hasn't done anything, right? It's struggling. Well, it's in a consolidation, right? It can't seem to get above this level. Okay, so now it's stair-stepping its way higher. Well, when it was looking ugly, I was up 10%, so I decided to raise my stop to a 1% gain. That way, if it just absolutely rolls over, it's not going to mess with my psychology. If I have a 1% gain, I did not want to let a 10% gain turn into a loser. So sometimes that's a good rule. If your stock gets 10% or above, to just raise your stop to make sure you have a 1% gain. That way, you're still, it's not going to hurt you that bad mentally. And that's exactly what happened on this day. I think it was this day right here. It just came in, caught me. Even though it still held the 50-day moving average, and I still might buy this back. Now, this is a very thin Chinese stock, the smart e-scooter companies. But again, one's going to say, well, why do you have all these stops in place? Well, I'm going to say, why don't you? I don't mind a stop getting taken out because I can show you plenty of examples where I booked in some nice gains on some stops, and they just never came back. They just kept going down, 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 down. Curro is a perfect example. Sold right here when it broke the 50-day moving average. Bought right here. This is one of my nice winners last year. Never came back. Never came back. It's all the way back to 10. This is exactly why I use stops. So I'm going to use a hard stop. I'm never going to buy a stock without using a stop. I'm going to immediately turn around and place a stop right after the market order gets filled. And that's just to automate it. That way, in case something goes against me, I'm not going to get in trouble. So, here's another Chinese stock that I bought. I didn't really get up that much. I was up like 7-8%, so I never hit my 10%, right? So if I'm kind of learning something here as I'm doing this, I'm saying, okay, if your stocks take off and they get above 10%, but you want to continue to let them run, maybe just raise your stop to 1% above your purchase price. That way, if it comes and slams back down, you're at least not going to take a loss, right? 1% gain is nothing. It just helps your psychology. And trading is all psychology, so I really try to find rules that are going to keep my psychology healthy. All right, so I was up maybe 7-8%. I bought right here. Right, same thing with HEYE. It was just hugging it, and then it finally busted through. Plenty of daily volume. That's a buy. I buy that again every single time. It just didn't work out. It went up, and then earnings came in, and it broke. Okay, it came back and stopped me out for an 8% loss. I look at this now. It's coming back. It's starting to set up again. I look at this. I wouldn't have done anything differently. So, and sometimes you just have to look at it. Most of the times, if I want to change something, I would have done it on my winners, not my losers. I didn't do anything wrong in this trade. I bought it right. I had a plan, and it hit my stop. Okay? So be it. Now, VXX, I don't even know if that chart's not even live anymore. So I'll go to VXXB. See if I can pull this up. So, I had bought VXX, which expired. So I'll kind of bring this back for a second. VXX, well, almost a 2% loss. No big deal. Which means that if a 2% loss and I had a 10% stop loss on it, I really only lost 0.2% of my overall account on this trade. So I personally have some rules where if the market gets a certain percent above the 20-day moving average, meaning very extended, Or if I think we're late in a rally and the market has already tested the 20-day moving average twice, and now we're going up for that third hoorah, sometimes I'll buy the VIX, right? Just because I don't know how far the market's going to go, but if I've noticed several times when I own the VIX, it really pads your account. If all of a sudden you have a bad couple days in the market, you own some aggressive stuff, it really helps. Everything's down big and this thing's up big. So it helps you mentally when you look at your account balance to say, okay, even though I do have some individual stocks that are down big, my overall account value is balanced out. I lost a little bit on this. Again, this is just something I do. I don't recommend you doing that strategy if you don't really understand it or haven't done it before, but I like to do it to kind of pad my account. ROKU. Okay, so this is ROKU. I bought on this day right here. Bullish volume, bullish flag. I bought right here. It took a few days and then it started to take off. Well, of course, it continued to go, right? I just took profits at 7.4%. I didn't know that it was going to continue to go higher. It was right under the long-term moving average. So was the market. It seemed like a reasonable place to book some profits. And as you can see, it kind of struggled a little bit, but it found its footing. So I wouldn't do anything different sometimes in bear markets. I was not planning on this stock going to being really a 3R winner because, you know, it went straight down. It's not likely to go straight up out of this. It's going to go up. It's going to come back down. So and it still could. So just based on my experience, I said, you know what? I'm just going to book the profits on this. You know, looking back at it, I could have said, yes, I'll wait till it breaks a 20-day moving average. But if I would have done that, then you'd be back at break even. So, GDX. This was perfect. Bought on this day, sold in here. So really made a nice gain on this move. And then miners pulled back and I bought a mining stock. So that kind of worked out. Sold into strength and I still own SIL. And then it just pulled back, continued to pop. So this was a winner, nice winner, came back to support. Low risk trade because if it didn't work, I just had to stop 2 or 3% under it. If it did work, it surged, and it did. So worked out just fine. Okay, so again, I'm looking for risk reward of 3. I told myself if the market does roll over, look at DRIP. This is a inverse oil ETF, right? Look how fast it moved to the downside. So this is a bear oil and gas ETF. I said, okay, it kind of looks vulnerable. If this breaks, the 1222, I'm buying it because it could just keep going. Well, OPEC had other plans. I was almost at the 7-8% mark. I wasn't quite at 10. OPEC the very next day cut oil production, boosted price oil, and it came back. Nothing I would have done differently. This was a 10% loser or 1% of my overall account. I wouldn't have done anything differently. It just didn't work out because at the same time I was seeing this break out. Look at this day right here. Look at this day XOP. XOP right here broke this trend line. Looked like it was absolutely rolling over, but OPEC came in and supported it. That's okay. Okay, I want to look at another stock that we booked some profits on yesterday, and because it's a really good case study. And then I want to talk about a dividend-paying strategy. Okay, so this is a really good case study, American Silver Corp. I don't normally buy shares that are $1, but the volume was popping, gold miners were looking good, and I was going through a bunch of gold mining charts, and I just could not help it. Look at the surge in the volume up above this, right? then for the most part, there was less volume on the pullback, more volume on the pop, and then it created the handle right at support, reverse at support. So gold was reversing this day. We entered on that day, booked some profits yesterday before the Fed announced. That was a smart move. But I mean, this is kind of a classic textbook, right? You want to get it for a couple of times. You get a surge, right? But on the pullbacks, the volume is less, and then you're getting more accumulation. So there's some major buying coming into this. I'm not telling you to go out and buy it, but you know, when you see the complete pattern above the 50-day moving average, and then the handle is just ever so light volume, and there's just all kinds of big volume spikes around it, that's a decent setup. So not a bad trade. So, you know, I kind of want to recap, and then we're going to go over another strategy. I know this is kind of a long webinar. I actually might save. Okay, so, you know, looking at everything, it's done. We've done pretty well with it, with all the trades that we've taken. So these are every single trade that I take. I call it my portfolio. Trading system members are privileged to every single trade. They're fast movers, so I got to get them out quickly. So I just make a post and a text, send it out. So we've done pretty well. There's not really, looking back, you know, if I could just really, there's not really a whole lot I would have done differently. I had a plan. I stuck with it. And, you know, if I would have changed something kind of in my mindset, I would have said, okay, just keep in mind that the market can always go longer than you think it can. So kind of looking at ROKU, right? Looking at this stock, maybe I try to find a rule where I say, okay, maybe at least if it's up over 10% that I could have raised the stop to 1%. But again, I would have been stopped out. This could have been a 5% winner. Instead, it was a negative 1.8%. So I show you this and I talk about trade plans. So I'm hoping that you learn things and take things from me and, you know, develop your own trade plan that suits your personality. What I do with my risk model and with my swing trading and some of the things I do with the VIX might not be appropriate for you. But I hope at the very least you have a plan going into a trade, right? You visualize what you're going to do before the market opens. You execute that, and then you make sure you don't deviate the plan really until just something out of the ordinary happens, and then all of a sudden that proves your plan could be at risk, okay? Kind of like what I did, what was that? JD. I just looked at it with Weibo that was going down. I looked at it and I was like, okay, something is not right here. Of course, it was just fine, but, you know, hindsight, sometimes you just have to be willing to abandon ship, but you don't want to do that all the time. So we've done good. I want to talk about another strategy that is really for long-term stocks, okay? And I know this is a long webinar, but you're going to want to watch this. So this is a strategy really for long-term stocks. And I want to show you an example. So I'm talking about if you have a long-term stock, and let's just say it pays a 2-3% dividend, you want to hold it forever. Well, what if I were to show you a way where you could get a lot higher dividend yield on the exact same stock? And this is the way I'm thinking about this. So I'm going to use PAGS as an example. Okay, PAGS is something that I do own, and I just want to walk through a scenario just to show you how the possibilities of swing trading around some of your long-term positions can really have a very meaningful impact on the long-term value of your trade. So let's just say, for example, I own PAGS at $100 a share at 30 bucks, okay? And so I start with $3,000. That's my initiated position. Now I'm going to swing trade it 3 times throughout the year. So I'm going to swing trade number 1. I say an extra 10 shares. So what I mean by that is, let's say that I'm risking 1% of my account value on an additional 100 shares of PAGS, right? I'll say I gain 10%. So, and then it hits my target or it triggers a stop loss. That 10% gain on that first swing trade, I'm going to leave that in PAGS. So now I own 110 shares. Now I'm going to take the other 90 back, right? Because I don't want that whole thing to roll back over. Swing trade number 2, I have more success, but this time I get 15 shares. I get, let's just say 15%. So out of 100, so I reinvest the 15 shares and I sell the other 85. So now I have 125 shares, right? Let's say trade number 3, you lose 10 shares, okay? So let's just say you lose 10 shares, which is very possible, right? Because you're not going to make everyone right. But the goal of this is to really swing trade around the position so you can keep the shares in the long-term position that you won as risk-free money. So whether I make 3 trades or whether I make 4 or 5 trades throughout a given year, let's just say throughout a given year, I reinvest 25 shares. That is free money, that is dividend money that I traded after all the gains minus all the losses in this stock back in. So at the end of the year, I have 125 shares, and I realize this equals 15 net shares, but I'm just really trying to walk you through an example. So at the end of year 1, you have 125 shares because you swing traded 3 or 4 times your PAGs and you reinvested an additional 25 shares, okay? That additional 25 shares is risk-free money. It's house money. You can let it ride. So let's say I do that once per year, right? At a price per share, let's just say at the end of year 1 of $30, okay? So now that 3,000 is, and I'm going to assume something very conservative. I'm going to assume that each year you're only going to get an 8% gain on your shares. I think it could be much more, but I'm trying to be conservative, right? And you can kind of play with this math. So at the end of year 1, you have 125 shares instead of 100. Same price per share. Let's just say it didn't even move. Now your total value is $3,750. You do that again, year 2, you had another 25 shares, okay? Just swing trading, reinvesting it back in the shares. Plus you got an 8% gain, the price per share is $32. So now you have $4,860. You do that 15 years and your $3,000 can grow significantly, okay? Now, I'm trying to show you what I think is very conservative math. We're going to look at this on a chart here in a second. But if you start with a pilot position, instead of just dumping more money into it, what if you just swing trade around it and reinvest the winning shares? Write it as house money. That way, all I did here was invested $3,000 initial. I swing traded and reinvested 25 shares every single year. I didn't compound that 25, just an additional 25 per year. Only getting an 8% rate of return on the actual price per share. Look what it does to the total value after 15 years. This is a long-term strategy. That's why I'm showing you 15 years. Only invested $3,000. Now, you've made a lot of trades, okay? You made a lot of trades around it, but I'm assuming that you can win on most trades because you know your stock well. You know when it's ready to roll over. You know when it's acting right. So this is just a simple strategy for a long-term hold that can do very well. So what if I take this and say, okay, only 115 shares. And plus, let's just say I only did 15 shares. So I'm going to drag this all the way down. Nope. No, that's not what I meant. Just fix the math. So again, you start with 100 shares at $30 a share. You start with 3,000 bucks. I'll change it. What if instead of reinvesting 25 extra shares per year, you only reinvest 15 shares per year? See? Get the same 8%. Look at where your $3,000 investment is at after 15 years of swing trading around your initial position. So again, all you're doing is reinvesting the house money, the 15 shares you earn per year by swing trading your stock, and you're getting an 8% gain per year on your price per share. It's probably very conservative, I think, on your price per share. But if you picked right. But keep in mind, and this doesn't even account the dollar cost average, so I'm showing you this just to kind of open your mind to the possibilities of what you can do with some long-term positions. And if you're willing to put a long-term strategy in place, stick to it, you can do incredibly well. Let's pull up the PAGS chart. Let me pull this over. Okay? So right here, I'm going to go back to the P&L real quick. Made 13% on PAGs, right now up 6, about to sell that, lock that in, reinvest, the shares. Okay, so let's look at PAGs. Started around 30 bucks. Okay, I'm not telling you to go out and do this, pick your own stock, I'm showing you an example. Okay, don't go out and buy this stuff. 30 bucks, right? I'm assuming at the end of the year, after 12 months, let's just say August 2019, we're back at 30, which I think is very reasonable. Okay? I bought some PAGs right here. Alright? And I swing traded it until it broke the 50-day. It never broke the 20-day moving average. I had a game plan. Whatever it breaks first, the 20 or the 50, it broke them both in the same day. So I sold. I sold that day for a 13% gain. Well, guess what? The very next day, a big support volume bar came in. And I was like, you know what? I'm going to do that again with a stop under 2025. Only risking 1% of the account value per trade. All right. Now it's breaking the 20-day moving average again. So I might sell that. And I can always just reinvest those gains, which currently is 6%. And I believe on this one I bought 150 shares. So that'd be about 9-10 shares that I'm going to reinvest on this one. Reinvested a little bit more on the previous one. But again, I've only done that in the last 4 months. I've almost hit my 25 share target. So I just want to show you the possibilities and how you can use moving averages. You can buy moving averages support. How you can use moving averages as a stop. So when your stock is running and you buy a swing trade, just pick a moving average. Say when it breaks this, I'm going to, whatever gain I have, if it's 10 shares gain, I'm going to reinvest that and leave that in the stock, right? So I'm not telling you to go out and do this with your own stocks. I'm just trying to show you the math and again, show you possibilities of what's possible. And how if you stick with the long-term plan over time, you can increase your account value significantly. Now, how I came up with this idea is I'm looking at another stock that I own and I'm like thinking, man, 2.5% dividend really isn't that much. Like, that's going to add up over time, but it's really not that much. How can I increase that? What if I swing trade around the position and I get an extra 15 to 20%, or 15 to 20 shares? I'll consider that as a dividend and I'll reinvest that. So again, you got that snowball effect. So just want to bring your eyes into something. So let's kind of look at the market real quick. I know this is a long one. Yeah, market's kind of rolling over a little bit. But, I like to analyze my trades, one, for transparency, right? I want you to see what I do, okay? Two, I'm hoping you have your own trade plan in place. Maybe you can steal 1 or 2 ideas from me and you can put rules in place that are good for you. What rules are good for me are not necessarily good for you because they don't match your personality, right? They're going to match mine, so I'm going to stick to them, right? You might point out, you might email me, say, Steve, you made some mistakes. This is what you should have done. I'm like, maybe. But again, that it's my personality. You have to do something that matches yours. And I wanted to show you this idea. And I know this isn't like something, groundbreaking. This isn't something I came up with. I'm sure somebody else is doing this somewhere. But it's a really good idea for one of your long-term positions if you do it correctly. Let me know if you have any questions.